Welcome to the Pro Ticker Deep Dive. Okay, let's unpack this. If you are watching the stock market, say, here in late 2025, you really can't ignore it.
No, you can't.
There's this remarkably wide split happening based purely on company size. I mean, on one side, you have these massive technology titans,
Right, with valuations that just scream AI revolution.
and on the other, you have thousands of small companies trading at prices that, frankly, look almost insultingly cheap.
And that creates the greatest temptation in investing, doesn't it? The simple appeal of buying low.
Right.
But we've gathered the sources to answer the core question for you. Where does the structural risk, the real risk, truly lie?
Is it in the mega caps, which, look expensive but have these fortress balance sheets?
Or is it in that cheap small cap group where, I mean, think about it, close to half the companies in the index aren't even profitable.
So our mission today is really to move past that superficial discount. This isn't just about finding cheap stocks. It's about figuring out if that small cap value is actually a hazard sign, if it's masking a systemic quality and profitability crisis.
Exactly. We need to determine if this valuation gap represents a temporary bargain waiting to be closed, or if the market has just fundamentally re-rated the smaller end of the spectrum for a very, very good reason.
Okay, so to really appreciate the scale of this potential trade, you have to look at the numbers.
You really do.
The valuation gap between the large cap S&P 500 and the small cap Russell 2000 has reached proportions we just haven't seen in decades.
It's truly shocking. I mean, looking at the trailing price to earnings ratio, large caps are sitting way up there at 28.34.
And the small caps.
A measly 18.1. That is a 36% discount on trailing earnings.
Wow.
That tells you immediately investors are willing to pay far, far less for a dollar of small cap profit.
And that discount gets even starker when we look at price to book.
Oh, absolutely.
Right.
Large caps are trading at 5.01 times book value. Small caps are at a mere 1.66.
Just think about that for a second. You're paying roughly one-third the price for every dollar of underlying hard assets in a small company compared to a large one.
The difference is visually shocking. And what's fascinating here is the history. This is one of the widest gaps recorded since the dot-com bubble burst back in 1999.
And isn't it true that for a long time, small caps actually traded at a premium?
That's the thing. Historically, say between 2010 and 2017, they often traded at higher PE multiples than large caps. So this current inversion isn't just cyclical. It suggests the market is pricing in a deep fundamental shift.
So that suggests either small caps are poised for a massive rebound, or there's a serious underlying fault line. Given those staggering discount numbers, what is the single biggest reason the market isn't rushing in?
Well, the discount, as tempting as it looks, is largely an optical illusion.
An illusion? How?
It's rooted in a structural crisis. Our compiled research consistently highlights the problem. The index is, for lack of a better word, polluted.
Polluted with what?
Unprofitable companies. Approximately 40 to 43% of the companies in the Russell 2000 are simply not profitable.
And this is happening in a growing economy, not a recession.
Exactly. And since the index PE calculation includes those firms with negative earnings, it artificially drags the overall index valuation way down.
So if you strip out those loss-making companies...
The discount shrinks considerably.
But hold on, isn't that metric a little misleading? I mean, aren't many high-growth tech companies deliberately unprofitable for a while because they're funneling cash back into R&D to scale up?
That's a necessary nuance, you're right.
Yeah.
But in the small cap index, the picture's much darker.
Okay.
This high rate of unprofitability connects directly to crippling debt vulnerability. Unlike those few high-growth disruptors you mentioned, many of these firms are just struggling with interest rate exposure.
Ah, so they carry higher debt loads, often with variable rates and short maturities.
Precisely, which means they are acutely sensitive to the direction of interest rates.
So any move by the Fed has a much bigger impact.
A huge impact. The data shows a significant portion of the Russell 2000 is earning less than twice what they need just to cover their interest payments.
Less than twice. That's an alarming figure.
It's truly alarming. If you were a bank lending to this segment right now, you'd be sweating.
Yeah.
It indicates financial distress and makes the entire cohort highly dependent on deep rate cuts just to stay solvent.
That sounds less like a temporary dip and more like, I don't know, a single point of failure.
It could be.
But we keep hearing whispers of a silver lining. This explosive 2025 earnings growth for small caps, something like 26.5% compared to maybe 10.3 for large caps, surely that's the catalyst.
That's the earnings paradox, and you need to look at it with extreme skepticism. That 26.5% forecast,
Yeah.
it has a massive asterisk next to it.
Because they're not reliable?
Notoriously unreliable. We've already seen revisions for small caps drop by 5 percentage points just since the start of 2025. Large caps only saw a 2% downward revision.
And what does history tell us?
If history holds true, estimates between September and the following February are revised down by nearly 24%. That rosy forecast is likely already heading into the dustbin.
So we flip the coin. The small guys are cheap, but fragile.
Very fragile.
And the big guys look expensive, maybe even historically so, but their underlying foundations seem rock solid.
They absolutely are. That premium valuation for the S&P 500 is not baseless. It is supported by genuine, measurable strength that, frankly, justifies the price tag.
Okay, so what kind of strength are we talking about?
Well, the large cap winners, the drivers of the index, are entirely self-funding their massive capital investments. We're talking about the whole AI infrastructure build-out.
Right, and they're doing that from their own operating cash flow.
Exactly. That level of operational efficiency means they are insulated from the Fed's rate hikes and the credit crunch that is just crippling the small cap world.
So they have these fortress balance sheets. They're not dependent on accommodative monetary policy to stay afloat.
Not at all. Plus, all the investment capital is flowing there because the AI revolution is a real structural shift in where economic growth is happening. Their high valuation is tied to robust earnings and the defining narrative of the next economic cycle.
That sounds great, but it brings up concentration risk, doesn't it? If tomorrow's economy is increasingly built by just 7 or 8 companies,
Sure.
how does that volatility risk compare to the debt risk of 2,000 small companies? I mean, we are trading one type of structural risk fragility for another, which is concentration.
It's a valid trade-off for you to weigh. But the key difference is that the mega cap's concentration risk is tied to growth and disruption. The small cap's risk is tied to solvency. One group can afford to build, the other is constantly fighting just to survive the cost of capital. That's why the market assigns them such different multiples.
Okay, let's shift to the broader economy then. It really sounds like we're in a bifurcated expansion,
That is the perfect description for this muddled macro context.
where the signals meant to help one group end up harming another.
That's it. The Fed's rate cuts in late 2024 and early 2025 were explicitly intended to help those small rate-sensitive companies.
By lowering their debt servicing costs.
Right. But what was the predictable catch?
Let me guess, longer-term yields went up.
The catch is that longer-term yields have recently climbed, driven by expectations of stronger growth and persistent inflation. That just offsets the near-term relief the Fed provided. Rates are still materially higher than pre-pandemic.
And for small companies with variable rate debt, the damage is already done.
It's deeply embedded and persistent. And you see that confusion reflected in the trading action, right? The Russell 2000 has been locked in this grinding sideways trading range for most of 2025.
It's just stabilizing around key support levels, but with no real momentum.
No breakout. But
No.
the most dangerous technical signal, for me, is the performance divergence within the small cap universe itself.
Okay.
The unprofitable cohort of the Russell 2000 has surged nearly 19% year-to-date through October.
Wait, the unprofitable companies gained 19%?
19%. That's more than double the gains of their profitable peers.
Which only gained.
The profitable firms only gain 9%. This is not fundamental improvement. This is textbook speculative fervor,
Just investors chasing high-risk names, betting on the Fed.
purely on the hope of future Fed intervention. And if you look at the S&P Small Cap 600, which has that crucial quality filter,
It requires positive earning.
right, it underperformed significantly. It gained only 1.8% year-to-date. That divergence between 19% and 1.8% is the ultimate red flag. It's warning you against buying the broad, indiscriminate Russell 2000 index.
So if we connect all this to the bigger picture, for the learner listening right now, where is the actionable opportunity and where is the minefield? You can't just ignore small caps forever.
No, absolutely not. And there are legitimate bullish nuggets here. If rates do moderate and the economy stays resilient, there is significant upside for high-quality, profitable small-cap franchises.
The ones that have been punished by the market's indiscriminate sell-off?
Exactly. And those depressed valuations make them irresistible M&A targets.
Right, with all the private equity cash sitting on the sidelines.
Precisely. Private equity dry powder is at record levels. We anticipate an improved M&A environment where acquisition premiums could reward patient investors who've done their homework. Plus, you have potential long-term tailwinds from tax adjustments, deregulation, the reshoring of supply chains.
all of which favor domestic-focused small businesses.
They do.
So the temptation to chase mean reversion, this idea that small caps just have to mathematically catch up, that's where the landmine is buried for passive index investors.
The immediate risks are profound. That high dependency on rate cuts is a critical single point of failure.
If the Fed stalls or rates climb higher,
The small cap leverage story becomes a solvency crisis, and continued downward earnings revisions will ensure that the cheap valuation feels much more like a value trap than a real opportunity.
so the verdict is highly nuanced then. Small cap valuations are cheap enough to be interesting.
But not cheap enough to offset the structural deterioration of the underlying businesses within the broad index.
The bar for execution is incredibly high right now.
It is. The winning move is disciplined, selective investing.
So the best path forward seems to be a balanced approach. Maintain a large cap core for that stability and proven earnings power, but if you want small cap exposure, you have to selectively upgrade.
You have to quality-focused vehicles that screen for positive earnings and healthy balance sheets.
Rather than buying the broad, index-weighted minefield.
And this ultimately boils down to a question for you, the listener. Which structural risk are you more comfortable with? The concentrated valuation premium of megacaps based on future AI productivity, or the extreme fragility and high debt of the speculative small cap cohort?
See you all in the next Pro Ticker Deep Dive.